Okay. Hi, everybody. I'm Jen Henson, and the name of my company is Residential Capital Corp. And besides sourcing financing for fraternity and sorority houses, I also work for a nonprofit, and we provide housing for special needs individuals. And we have, I don't know, 100 and some what you might call group homes in like 11 states. So that's something that I also do, which is why it doesn't say Greek Capital Corporation. But anyway, that's kind of what I do. So Kyle, go ahead, change your page. Okay. COVID hopefully is slowly getting behind us, but I can tell you that it really brought to light the topic that we're going to explore here today, which is the need for financial reserves. 2 years ago, I was fortunate enough to source financing for over $32 million worth of fraternity and sorority house, new builds, substantial rehabs, whatever. And last year I was 24, largely because many projects had to move to this year from 2021 because they didn't have reserves. And it's really important that we zero in on a couple of things here. First and foremost, that your chapter house is a business. And whenever I work with house corporations or the national entity, that's one of the first things I look at is what sort of fees are coming in versus what your operational expenses are. And for instance, and it's absolutely remarkable to me, your food service. I can't tell you how many times I run into a situation where the food bills aren't covered by the meal plan that is being collected from the guys. And how many times there isn't maybe a capital needs assessment that identifies the mechanical issues or the roof or what have you, that a reserve needs to be set aside so that that can be addressed when it needs to be. The housing contracts are not sufficient enough to say, hey, the chapter is going to pay for utilities, something I recommend, or who's going to be responsible for what things might go on at the house. And I know during the presentation that was done earlier, we talked about protecting the house corporation and the national fraternity from any sort of bad things that could potentially happen. Some of those things can be covered in a master lease, and many national organizations are moving away from some of these individual houses to just having a master lease. They might then have a list of house rules, if you will, but just really identifying that what is the responsibility of the individual chapter. We need to review the terms of any debt. Oftentimes, there's existing debt on some of your houses, and you're not even aware that, for instance, there's a prepayment penalty. And so when I work with a house corporation or a national entity, first thing I do is ask that question and then look over the documents that are in place to document that loan and see if we've got any sort of hook in there that says, we've got a 3-5% prepayment fee that has to be taken care of. So all of those things are and I applaud the recommendation of working with third parties and accounting folks are really good, whether it's Omega Phi or Greek Bill or what have you. They really do have some good systems that are out there that can help you keep on top of how your costs are running. So, okay, Kyle. Greek houses, fraternity and sorority houses are not treated in the marketplace like your home loan. They're commercial multifamily. They're not even similar from a valuation standpoint to apartment facilities. These are considered special purpose housing. They have all sorts of different requirements that the appraisal has to address. And one thing that I like to be sure of is that when we are working with a lender, that they have experience with doing a loan on a fraternity or sorority house, fraternity house in our situation here, just because there are differences. And I also make sure that the appraiser that they reach out to give us some quotes has some experience with fraternity and sorority houses. The other thing, just to let you know, is with a single family residence, or when you have your own individual loan, if you looked at the appraisal, all of the comps were probably in the neighborhood or within a very close proximity. Even on HUD multifamily deals, they like to have the comps within 25 miles of the subject. Well, a MAI appraisal on a fraternity or sorority house, you could have the comps all over the country. They are probably out of state. And that's just because, there are only, I think, 8,600 fraternity and sorority houses on campuses across the country. And so, finding one that is going to be a good comp for, the project that you have is really, really important. The other thing that's very different is that, when you closed your single family home, you didn't have to have the need for any sort of a, tolerance for what your loan payment has to be in relation to your net income. Or if you did, it was very generous. It was probably, maybe 50% of your loan payment, or excuse me, of your income had to cover your loan payment. In a debt service, which is the loan amount, your net operating income has to be 20% higher than the loan payment. And, what is included in that net operating income number are things like replacement reserves and all sorts of, utility expenses. And if we included meal plans in income, we have to include the food service in the expense, and hitting that 20% higher threshold is a challenge.
Hey, Jen.
Yeah.
Yeah, no, just to kind of piggyback on just two items you mentioned there is, when we went through our new build project,
Yeah.
that the appraiser basically zeroed in on the basically an as completed basis. What would it cost to build this house based upon the plans? I can't remember if they pulled any comps from other fraternity houses. They literally looked at what is it going to cost, and is this going to do it, from a loan standpoint. And then from that operating income side of it, obviously we don't have the food service issues and everything. I remember in our discussions, we really tried to view this as an arm's length transaction where our housing corp collected a rent check. And, the tenant or the fraternity was the one that was responsible for paying the bills, et cetera. So that really kind of helped us back into what that rent needed to be to hit that 20%, that 1.2 debt service coverage on it.
Yeah, no,
But
you're
it made it a little
right.
easier when we really treated it like an arm's length transaction between the house corp and the fraternity.
Yeah, that's a good comment to make, because and especially now post COVID, replacement costs, I mean, they're through the roof. I'm working on a number of projects, substantial rehabs or new builds, and we have general contractors that, the costs are so high, they're wanting to have 15 to 20% construction contingency. Well, you just don't hear, we didn't hear about that a couple of years ago.
Yeah.
And
we got caught up in it.
Yeah, we've just totally gotten, caught up in it. So with our projects, there are three approaches to value, and oftentimes the income approach, sad to say, only kicks in if there's actually a lease with the university that's out there. But the sales or market and the replacement cost are two different approaches to the valuation. And then within the MAI appraisal, the appraiser, looks at both of those, stands back and says, okay, what actual valuation, final valuation am I going to give this property? And so it's usually a hybrid in between the two, or if he feels that one's more relevant than the other. Also when you look at sales or market, as with single family homes, the sales prices are going through the roof. Oftentimes the same thing is happening with, a market rate project that might be, out there, similar to where our, folks or students, could live someplace other than the fraternity house. The other thing that's really happening, because and this has actually been out there for a while, it was something that came up post Dodd-Frank, but especially in the last couple of years, and that is it's called high volatility commercial real estate, which is applicable. The underwriting criteria is applicable for our houses, and basically what it says is, in some circumstances, a lender actually can make a loan at 85% of the appraised value. Now, I know most of you guys are probably listening to from lenders, if you talk to them, hey, we don't want to go any higher than 75 or 80, but I can tell you that there are some circumstances that will permit a lender to go as high as 85%. And I work with, lenders all over the country and identify, what are those circumstances need to be. Now, they may want to, have some, an extensive banking relationship. There are different things that they might want to have, but, it can be pushed if, we're just really short on cash equity, borrower equity that we can put into the deals. The other thing that's unfortunate about these projects, unlike multifamily and single family loans that are made by banks, these are not sold in the secondary market. So the pricing of these loans is totally subject to usually the cost of funds, maybe the 10-year treasury, which is a benchmark that a lot of banks use. They used to use LIBOR, but that doesn't exist anymore. These loans don't earn any CRA credits. You really almost have to convince a lender that this is a good deal to do, which is why I have been very successful working with credit unions and smaller community banks. The deals are large in many situations. I mean, you get into the South, you're looking at, $10 to $20 million houses on the West Coast, similar situation. But a lender isn't going to get any credit for that. So oftentimes when they price it, they're going to want to price the deal on a shorter duration, which means instead of, maybe a 15-year fully amortizing, they want the deal to be repriced after, say, 5 years. Okay. Thanks, Kyle. Well, go back. Yeah, I think that's where we are. Yeah, next slide. Okay. And again, because there aren't any secondary market guidelines about underwriting, they determine their own financial reserves they want you to have. They look at the risk, and the risk that often presents itself is the chapter has to leave campus, and then what happens? A lot of times I spend, when I'm doing my research on your project, to see if there are other groups on campus that just aren't housed. I also, matter of fact, have been working on a situation where the house is absolutely huge. When it was substantially renovated a few years ago, it really could be repurposed into an apartment project. Now, I don't think that's the kind of fraternity house or the kind of facility, I guess, that really is a fraternity house where all the rooms are their own suites and their own kitchens and all that other kind of stuff. It kind of cuts down on some of the bonding that can really be done. But that house will probably have to be converted into an apartment just because it's not, the chapter just isn't strong enough to support the debt service that needs to be in the house, needs to be earned on the house. Oftentimes a lender, especially if your debt service coverage ratio is going to grow to the 120. So maybe we start out at 115 with the understanding that in 2 or 3 years, it might get to 120. A lender will probably want to have some sort of a debt service reserve. They will consider that collateral. So whereas the appraised value of the project is collateral, they'll consider that debt service reserve to also be collateral. And oftentimes it's got to be at least 6 months. I've seen many, especially now, if the chapter, and these lenders go back and they look at Facebook, they look at online articles, if they see some unfortunate things that the chapter's been doing, they might ramp up the debt service reserve to 12 months. So one of the things that I tell house corporations is, boy, check, what the chapter's doing out there, posting on Facebook or, anything, they've been in trouble with the university, because the lenders will find it. I'll have to explain it. And, membership reviews or, whatever, the national fraternity decides to do. But that's just something that could also impact the reserves if they feel that there's a risk here of the chapter. When I build the pro forma, and I do that day in and day out on projects, and then refresh it as new updated financial statements pop out. Operating reserves is huge. And I can tell you, especially during COVID, where members weren't, maybe living in the house, or, you were struggling with, what do we do with the rent they've already paid, building some sort of operating reserve at 20% of net income really got some of them over the hump for being able to afford. Yes, did they have to take some of those reserves and help make loan payments? Yes, but it was something that got them through it, and it was a good thing to have in reserve, if you will. What are you doing, Charles, with your reserves?
We're not at 20%. I know that. It's with the house being brand new, I'll call our capital repairs, kind of reserves for that, or we've kind of held those pretty low. With the day-to-day on the operating side of it, I think we're holding back maybe 10 or 15%. It was interesting with the lender that you and I worked with. They really didn't focus on that.
Mm-hmm.
It was kind of interesting. I was expecting to have that issue.
Mm-hmm.
Obviously, a cash flow thing was paramount to us as we were underwriting this based upon the targeted numbers of members and such. But with that lender, they didn't really focus on the reserves like I thought they would. They were really focused on our fundraising efforts,
Mm-hmm.
to fund the equity in the deal, and then also that debt service coverage, just that the rent that we contractually agreed to with the chapter was enough to hit that and stuff. So that's, if I remember correctly, back about 2 years ago, year and a half ago, that's really where their focus was, and not so much on the reserves.
Yeah. Okay.
So, right now we're trying to build up those reserves, what we're doing.
Yeah.
With the house being just completed last fall.
Sure. Well, some of these rule of thumbs have just popped up, in the last year with, COVID largely, and realizing that costs have gone up so much, and now energy costs have gone up, which are going to be utilities. That's pretty much what I have encouraged house corporations to do. But you bring up an excellent, comment regarding fundraising. When the loan closes, we have to have the cash at the table.
Yep.
And to the extent that fundraising is probably collections over 5 years, that's great. But when we actually close, we need to have all the cash there. And I do a sources and uses analysis that says, this is how much we're going to need, and here's the loan amount, so that the lender is sure that the house is going to be able to be built or renovated.
Yeah, that was a key thing for us. We had enough. Another thing, I don't know if we just can really tap dance very well, but the lender actually funded on the front end and let us do the equity on the back end.
Yeah.
Because we had raised a lot. We still had a gap to close on it, but I think they just got comfortable with our level of commitments, what we had brought in the door, what we projected coming in by the end. So, I guess sometimes better be lucky than anything, but we were able to get through that. And, and I'm glad we were ahead of this issue with COVID. When we pulled the trigger was literally that fall of COVID, that first fall of COVID. So I think the banks are still kind of figuring stuff out. So we didn't get, while we made the calculated risk to move forward, I'm glad, because we got ahead of the cost a little bit, still got bit on a few things, but we also got ahead of some of these more stringent underwriting issues. But as we're trying to refi them, we might get caught up in that.
Yeah, well, let me know. Yeah. Okay, I understand we've only got like 5 minutes, so let's look at the next slide, please. The unknown is the value of the house, and I can tell you right now, values are really, they're not coming in. The cost of labor and materials has gone up so much that the appraised value, I mean, a 2x4 doesn't lend any more value if it costs more. So therefore, we've had to look at additional collateral. As I said, the debt service reserve would be considered collateral, some pledge of investments, potentially. And the only way you're going to do a cross collateralization is generally a deal. And I've done this with the national housing entity of a fraternity or sorority that happens to own other properties. And in essence, the equity in that house is given to the house that needs the work done or the loan or what have you, so that it can, we can get the deal closed. Okay. Kyle. Okay. I know we're gotten kind of compressed here, but any questions at all that come up, or you want to hold them off until the food court? Anything?
Jen, I'm curious, from a rate environment with everything we're facing, what are you seeing for people that are out shopping deals right now? I mean, we were pretty fortunate, we're once again to be a little bit ahead of it, but obviously it's one of the things we look to refi, kind of that mezzanine piece in our deal. I'm wondering where you're seeing rates now, given,
what's happened in the market.
Yeah.
I got to tell you, what's rates are probably down, but the reason why is they're pricing them off of a shorter duration index. So whereas they were pricing them before off the 10-year plus the spread, I mean, the 10-year now is over 2, and the spread might be 2.5 or 3. So instead, what they're doing is they're backing it down to, say, a 5-year, which isn't that much lower, but they've shortened the it gets repriced after 5 years, so they're also bringing down the index. So I got a term sheet for a project that I'm doing actually at the University of Oregon, and the pricing on it is 410.
Really? Okay.
Yeah.
So are they locking in, or are they kind of going variable given the uncertainty?
No, I don't really encourage people to go variable, and I also don't encourage them to look at swaps at all, because the variability of both of those. But no, they're locked in. Unfortunately, they're only locked in typically for 5 years, but they get repriced after 5. It's not that a balloon that comes due.
Okay, so it's not a balloon. So it's not like a 5-year maturity, 20-year AM. They're actually just amortization, but they reprice it in 5-year chunks.
Yep.
Okay.
Yep.
I'm John Briggs. Am I on audio here?
I'm sorry.
Well, can you hear me?
Yes, I can hear you.
Oh, wonderful. I'm John Briggs. I'm the treasurer of the Georgia Tech House Corporation.
Mm-hmm.
Our house is about 9 years old, and we have a 10-year commitment on a loan that's down now to about $2 million. And we spent about $4 million building the house. I think the current loan is about 5.4% interest. And I've given some information, financial statements and things to one bank here. I haven't heard back from them. What interest rate would we expect? We've got $250,000 or so of cash.
Well, not only cash, but I'm going to guess you've got significant equity in the house as well. I actually have a credit union that I use, and I got pricing from them on a project at Ole Miss just this week, and the rate was at 4 on a 25-year amortization.
25-year amortization and balloon when?
No, it's going to reprice after 5 years.
Reprice, what does that mean?
That means in 5 years, they will take an index, that they'll determine, and I can't remember which one. I think it's a 5-year plus a spread. And your rate will change, but you'll have the ability to prepay principal without penalty.
Okay, so it's a 4% guaranteed rate for 5 years.
Yep.
And then at some point before that, they'll
let you know what it's going to reprice to and give you the opportunity to refinance with somebody else.
and your firm does what? It puts these packages together?
Yep, I source financing for you and I get you term sheets so that you can evaluate lenders that are interested in providing you financing.
Okay, how do I contact you, Jen?
I think my contact information is the last page of the presentation.
Oh, okay.
But my phone number is 614-246-2424.
2424. And generally, what is y'all's fee for doing something like that?
My fee is 1%, but you can pay it over 12 months. It can be deferred.
1% of the loan?
Yep.
Okay, all right, thank you.